Well, this program's got a lot of substance to it, and I know it's of interest to a lot of folks, so we want to get going. But I want to introduce Dave Taiclet, who's the moderator. Dave's achieved great success in private equity as both a general partner and the CEO of a series of successful food and agribusiness companies, including some noteworthy turnarounds. After graduating from Notre Dame and before entering Harvard Business School, got it right this time. I insulted him yesterday when I said it was Harvard Law School. But Dave served on active duty for 4 years as a captain in the 4th Infantry Division of the United States Army. Like many of you, Dave's been an active Catholic fiduciary, but I think most interestingly, he's a member of the Candy Hall of Fame. Now, he made us take that out of his bio for the program, but I wanted to make sure you knew that. But he's a lock to be inducted into the CIS Hall of Fame. So before I ask Dave to come up, I want to offer a special thanks to Kelly Fontaine, who's on this panel, along with her colleague Michael Kim. We're partnering with their firm Sendana as part of our new venture strategy, also in partnership with Hamilton Lane, and we're really grateful for them. They came from San Francisco. They've been great partners for us. Really appreciate all of the work that they've done with us, and we look forward to a long relationship with them. And then finally, one of our panelists, Steve King, recently climbed Mount Kilimanjaro. So we wanted to make sure that you saw. Steve's you see in his bio, he's a fabulous Catholic fiduciary in Chicago. But I wanted you to see that picture because it wasn't. What did you say? 36,000 people climb it every year, but
roughly.
But
like
how many take the route that you did?
1%.
1%. Okay, well that's pretty good. So, all right.
Hopefully, it's not a reflection of my investing acumen.
All right, Dave, take it away.
Okay. Thank you. Good morning. Good morning, everyone. It's great to be here. Thank you, Tom, for the introduction. Also, just a thank you, Tom, Jack, Scott, for organizing this. You skipped the day one recap, but I think we could just do this right. We could just do this right here. I thought it was a wonderful first day. I think there's a strong consensus that we should try this again soon, and appreciate it. But we're here to talk about private markets. A lot of discussion around that. And we have a wonderful group of panelists, and I'll ask each of our panelists to introduce themselves. But we have Kelly Fontaine, you saw her introduced, Steve King, and Jackie Rantanen. Please take a few minutes to introduce yourself, your company, and maybe some of your experience as well along the way.
Perfect. Thank you. I'm Kelly Fontaine. I'm with Sendana Capital, as mentioned. I started my career in traditional finance at Capital Group and Credit Suisse. I was based in San Francisco, though, and all my friends were having much more fun at their jobs. They were very mission-driven and loved building companies and were very passionate about their careers. So I wanted what they had. And so I became a founder, and I joined a startup that did IPO. And along the way, I met Michael, who has been a friend for a long time, and he built something, Sendana. He was very early to seeing a disruption that was happening in the venture markets. So in the 90s, you had to buy Sun Microsystems, and you had to buy servers to start companies, right? You needed $5 million to start a software company because you had to buy the servers. With the invention of cloud, you could start a company for an order of magnitude cheaper. But the great venture firms had all gotten very large. And so this disruption allowed what we call seed funds to emerge and really focus on early stage. So he was the first to really identify this and went all in on it, and that's where we still focus today, is the earliest stage of venture. We focus on pre-seed and seed funds. Our main investors are foundations and endowments, and we're investing out of Fund 5, which is what CIS Access Venture Fund will be going into as well.
Yeah, great fun. A great Fund 5, great story about your company. Thank you. Steve?
Steve King, good to be with all of you this morning. I've been in the private equity business 30 years, amazingly. Started helping a bank launch a private equity business, and then several years after that went off with one other guy to form Prairie Capital. So we are now in our 26th year of our 3-year plan. As we talked about yesterday, there are strategies from A to Z in private equity. What we do at Prairie is we buy businesses exclusively from entrepreneurs. We're a control shareholder. We're the first institutional capital. And we try to do that pursuant to investment themes that we identify where we think there is unusually high rates of primary demand. So we end up investing a lot in healthcare services, education services, tech-enabled business services, and some consumer. If you're going to distill our investment philosophy into one axiom, it would be that macro trumps micro. And we can fix the micro, and we do. We invest heavily in the micro, but man, we want to be invested in sectors where there is strong tailwinds.
Great, thank you, Stephen. Great. How many funds did you say?
We're in our 7th fund now.
7th fund. So 5 funds, 7 funds, very experienced investors. Jackie.
Yeah, I'm Jackie Rantanen. It's nice to be with you all. I'm with Hamilton Lane. You heard my colleague Drew talk about the organization a bit. I've had the great fortune of working here for 25 years. So I started in private equity in 1997, and I had no idea what it was, and no one I knew did, and you couldn't Google it. So I met what was at the time about 10 people who worked at the organization, and what I saw was that they were helping investors to access a part of the investment landscape that was really difficult. And I thought it would be a great place to learn, and it has continued to be a great place to learn. I had the opportunity to join a company that was leading an evolving part of the asset class and the investing landscape. What I do at Hamilton Lane is to help create products, commingled funds that really create a specific solution for investors. We'll talk more about the complexity of the private markets asset class, but what we have done is to really help investors be able to pick and choose to guide their exposure in ways that make sense for them, knowing that every investor is unique. And so we have done that across equity and credit, infrastructure, and most recently with my partner Dave Helgerson, into impact investing. So really allowing investors to specifically align their capital. It's exciting. I think the asset class is more exciting today than it's ever been, and I have some perspective on that ever been. So.
Yeah, so I think we have a great panel. We have venture capital, we have buyout, we have people who are putting products together that consist of funds such as those. So Jackie, why don't we stay with you here and just kind of level set. Yeah. Let's do a basic overview, call it private equity 101 or private markets 101, and talk about the different segments. Just so we had some discussion yesterday, but I think it's great to kind of go back a little bit and talk about that because we're going to dive in to those different pieces.
Yeah, it is helpful because so many times we talk as if everybody knows what we mean, and private markets, it's important. It started as private equity. It used to be venture and buyout. Today, it is much more diverse. But at its core, what we're talking about is investing into private companies. And typically that is done in a fund structure with an expert. And I think the key that might get lost sometimes in the conversation is the thesis is to buy these private companies and to fundamentally change, improve, or grow them. And that is why you can exit these companies better than you bought them. So each strategy is different. And so Kelly will talk about, at the early stages of venture investing, it's about commercializing a technology. At growth equity, it's about, adding capital to really grow a business to become a more kind of mature business. For buyout, the mature businesses, it's about adding product lines, creating efficiencies, expanding geographies, maybe improving the management team. There are a number of different things. And then you can go down the line. There's distressed investing. All of this is part of it. And then it's about being smart on how you exit and when you exit. There's a misconception that the only way that private markets exit is through IPOs. It's not. That's actually a small portion. It's an important portion. But there's also sale to strategic buyers. There's sale to other larger financial buyers who can take that company and grow it in an even further direction. And so really what it is allowing investors the opportunity to participate in a really important part of the global economy. It's these innovative, growing companies, often change makers, that absent a private markets exposure, you would not get that exposure in your portfolio. And so we think about it as a diversifier and as a complement to broader portfolios. But then within that, understanding that each of the different strategies brings with it its own kind of complexion, if you will, risk-return profile, investment cadence. And really what you have is this rich opportunity set. Drew talked about it yesterday, really rich in terms of the number of companies, and then the number of professionals who are expert at applying a value creation strategy and then exiting them. So on the surface, it's easy. It's buying private companies. It's a little bit more complex, but it's really important when you think about, again, a diversified portfolio.
Yeah, great. One of the things you talked about was venture capital and early stage. So Kelly, we'll turn to you to talk about early stage venture capital. Your fund is actually a fund of funds. So let's talk about what that means and what that looks like. And then two, maybe you can talk about some of the technologies. You talked about some of the disruptive things that your partner saw early on, but maybe some of the things that are happening that some of your funds are investing around that the audience might be interested in hearing about in the VC world.
Yeah, so venture is a spectrum, as Jackie alluded to. So at pre-seed, you have a founder and an idea. There's not even a product yet. At seed, there's a product, maybe some revenue. If they do well and get $1 million, $2 million of revenue, then you get a Series A. So it's step by step, and then you get to growth investing. So it's a spectrum of risk. The riskiest thing you can do in venture is invest in one company at the earliest stage. It can go to zero very easily, more likely than not. But the return is unbounded, right? It could be Facebook, Uber, Google. The next step is a fund, right? You have a portfolio of, say, 30 companies. It can, if you have one of the Ubers in there, it'll do very well, but there's still risk. And then the least risky thing in privates is a fund of funds, because we capture 1,000 companies in one of our funds. It's diversified by geography, by sector, so all of that reduces risk. And then most importantly, we allocate over 2 to 3 vintage years, and our managers are then investing the capital over 2 to 3 years. So you capture 5 to 6 vintage years of companies, and that's extremely important in venture. You cannot time innovation. So if you look at the 6 months post-2008 Lehman Brothers collapse, Uber, Pinterest, Airbnb, Slack, they were all founded during that time. So you cannot time technological innovation. You asked about what's happening in tech right now. Well, so if we go back, we can look at big inflections, right? The chip, the personal computers, smartphones, social, cloud. These things are platforms that then create big companies and the opportunity for big companies. And the buzzword a few years ago was blockchain. I think only a portion believe that, right? It's a lot of effort to rip out old systems. I think AI is real. And I think there's real tangible implications that you're already seeing of the enhancement. And I think that's a big technological platform shift happening right now. And again, you can't time it, but that is the platform that we are seeing emerge right now. And again, it's staying in the market and being there for when those shifts happen. I would also say, there's been a lot of money going into climate and sustainability, and there's real things happening there.
So AI, climate, sustainability. Going back to your comment about the 30 portfolio companies in a fund, so you're the fund of funds. Of the 30, how many do you expect to just go to zero in a typical venture? I think it's an interesting number for the
So venture is a power law game. And so you're not hoping that all 30 are going to do well, especially from the early stage. We have portfolio data on ours where the mortality is extremely low. It's been a different type of market. But you expect what we call in venture an acqui-hire. So a company is acquired for the talent. So about 25% are acqui-hired. But it really is 2 to 3 portfolio companies. If you're lucky, 5 will really drive the returns in the portfolio.
Interesting. So we'll come back on climate and sustainability. There was a lot of discussion about that in the previous panel. So let's turn to Steve and talk about the buyout world and a couple questions. One, we've seen interest rates go up over time. Loved your perspective on your deal flow and how higher interest rates has impacted that. And then if you could also talk about valuations in the portfolio and how that's been and how you've dealt with that. Is there a lag to that? How are you thinking about that?
Sure.
Because I think a lot of our audience have private equity exposure, and you need to convince them that they need more private equity exposure or a little bit less. But
Well, on the first question, Dave, certainly, I described our strategy as basically being growth buyout. So we're not big leverage users. We use some. Other strategies, some that Jackie referenced, are big leverage users. And so to the extent your cost of capital is going up, rates rising.
just pause on that for a second, though. The leverage that you're using when you're doing a buyout is roughly what? And we'll talk about other extremes. So
it can be from nothing of the capital structure to 20% of the capital structure. So we are really investing heavily in these companies to steepen their growth slopes. That's what we do. But again, I think that's a little more the exception than the rule, certainly in the buyout business.
Definitely.
So your cost of capital goes up, that's going to impact your view of value, for sure. But a bigger driver really currently is not the cost of debt, but the availability of debt. As the Fed has ratcheted up rates to tackle inflation, I think the leveraged lending community has really gone risk off. I mean, they are just not interested in taking on a lot of exposure right now. And so, at the end, their economists have convinced them there's going to be a recession. And these are the same economists that have successfully predicted 6 of the last 3 recessions. So, we'll see. But at the end of the day, in private equity, what your company is worth is what somebody is willing to buy it for. And so to the extent, the availability of debt has contracted, your business is not going to be traded for as high a value as it would have been pre this contraction in credit availability. And we've seen that. And before we really recognized that lenders had gone risk off, we took one of our consumer services businesses to market this summer. Terrific business, rapidly growing, and got a lot of aggressive indications of interest and made it through, we're working our way through our traditional sales process, and then the lenders disappeared. And so we pulled our process, we said, time out, this is a wonderful business, we're not going to sell it at suboptimal value, but we had to recognize it's not worth as much today as we thought it was going to be because of the credit markets. Now, offsetting that is there's, as many people in this room know, there's a huge overhang in terms of private equity capital available. So people are going to be putting that money to use. And so we have another business right now, for example, that it's an education company, and it's a land grab. And so the right buyer of that business won't be using much debt. It'd be like a sin to capitalism because they should be investing like crazy to take advantage of the market opportunity. So there, we're going forward with our process, and it's going very well because the buyers are basically going to, over-equitize, if you will, the acquisition of that company.
Yeah, interesting.
It's interesting because
go ahead,
Steve brings up such an important point that really speaks to the evolution of the private markets. Because really, after the global financial crisis is when private credit started to become such an important point. That was also a bank risk-off time, if you will. And so the banks didn't want to lend. These are still good, strong companies. We're not talking about distressed investing. That's a different piece. But good, strong companies that...
People often ask me if we do distressed investing,
Yeah.
and I always say not on purpose.
Not on purpose, yeah. But it's about that, right? So that it's these private lenders that are adding capital oftentimes to these acquisitions and to the growth opportunities. So it's interesting as you think about, we don't have time to go through the entire history of private markets evolution, but it's these types of periods in time that I think show the importance of having the diversity across the private markets.
Yeah, so just keep going with that on a creating a private portfolio.
Yeah.
Can you speak to like vintage diversification? What does that mean? Kelly alluded to it a little bit. That's really important in venture to make that steady state and have multiple vintages. But maybe you can just talk about how you would view that and advise people about their portfolios.
Sure.
In that case.
So vintage years in private equity and private markets indicates the year in which a fund that Kelly spoke about starts investing. So when you think about a fund of private markets investments, that's typically a 10-year life. So they spend a couple of years drawing down capital from investors, investing into those private companies, and then they spend a couple of years implementing that value creation and then selling. And so that's the time period there. And so when you think about building a portfolio, having exposure over different vintage years allows you to capture a wider set of opportunities. As Kelly said, it really allows you to capture innovation. The thing that's so important is it takes that decision off the individual investor to say, yes, no, I want to lean in, I want to lean out, because we'll get it wrong. Even the most sophisticated professional investors will get it wrong. Just when you're most nervous, Kelly gave great examples, is oftentimes when innovation happens. And so vintage year is really, really important, but so is thinking about early stage venture or growth equity or private credit, and thinking about the risk return profiles, the exposures that you'll get, how they'll complement and add to the rest of a portfolio program that you have on the public side. So today, all of that is available in terms of being able to make specific choices and complement. But it really does start with a plan and understanding your own risk profile, and then being able to add appropriately. If you remember, Drew showed a lot of charts yesterday. The one slide had two charts, private equity on the top and private credit on the bottom. It showed the private markets returns against the public benchmarks, showing that privates typically outperform publics. What he didn't mention, but was there, was not every bar was the same size. And so if you only picked one vintage year, maybe you got the good one and maybe you got the less good one. Maybe you beat the public markets, but you didn't maximize your opportunity. And so it's really about having consistent exposure. Kelly said it, we can't time these markets. So having some consistent exposure and being able to kind of ride the cycle and capture, the performance over time.
So making a commitment to the strategy, sticking with it, trying not to pick the years or the companies at any given time.
Right, understanding your own profile and then building a plan to build over time, have some consistency, maybe have some flexibility, be tactical. So in today's market, you might want to lean into private credit, you might want to lean into venture, you might want to lean into secondaries. That just depends, but to really have a broad-based program that allows you to build over time.
Yeah, great. Maybe pivoting a little bit, we talked about banking, financing, leverage. Obviously in the news, Silicon Valley Bank. You're in the venture world. Clearly had to have some of your companies involved at Silicon Valley Bank, maybe Signature Bank as well. I even saw this morning that Credit Suisse was kind of blaming their woes on Silicon Valley Bank as well. But do you have a perspective on what transpired there, how you mitigated that risk, Kelly? And are there things that you've now instituted, maybe from a diligence standpoint, that really wasn't part of a process before? And we can all jump in on this because I think it's really relevant to how we're all thinking about this right now.
So I think for everybody outside of tech, you need to realize that not every bank wants to bank small technology companies that are not profitable and small venture firms. And so Silicon Valley Bank was a pioneer in the space. They were a partner, they were our partner, they were many of our funds partners, and over 50% of the company's partners. And I use that word because they were more than a bank, they were friends, they are our friends. So it's very sad, it's very sad. And I think that's lost in all the finger pointing. I think, the services of the bank can be replaced, right? People are going to look at the money center banks and stability of banks and go to the too big to fails. There are tech banks like Mercury, Brex, Ramp that are technology solutions that many companies and firms are implementing as well. I think everybody will use a redundancy of banking and have different treasury management. venture capitalists themselves don't really keep cash on hand, right? You call capital from your LP when you want to make an investment. So it really is directed towards the companies and how they manage their cash. And so, as far as how we use cash, we draw down on a capital call line of credit, and then we invest, and then we pay that down every quarter. So we'll never have a bunch of cash on hand, but it really is the companies and working with the companies and making sure they have the redundancy of bank accounts, and we do as well.
So have you set up new monitoring procedures with any of the companies, or is that part of your funds? You delegate that down to your funds, secure funds of funds?
We are very close with our managers. We do monthly calls. We consider ourselves part of our strategy as being high conviction, and we look for managers who are high conviction as well, meaning they're the lead investor. They're getting the most ownership of the company in the first round. So they are very close with the companies, and we work very close with them and have worked very close. We have a very active Slack channel of everybody working together, actually, in how they're advising their companies, what strategies are working well. We would talk to later stage capital to understand how they're advising companies with bigger balances. When you're a company that raises $300 million, how do you handle that, right? So it's been very active, and everybody's really come together.
Good, great. Steve, I don't know if you have a comment on the banking and impact for you
just
and
another
your team.
illustration that we all learned in COVID, and the value of liquidity. I mean, who would have thought that a bank of that size would not have paid attention to liquidity at a sufficient level? And so, at the end of the day, private markets, a lot of returns historically were a function of leverage, and we've always maintained that the cost of too much leverage is a lot higher than the cost of not enough leverage, and so having liquidity is just critical.
To that point, venture doesn't really use leverage. I don't think that's been addressed.
Right.
So the earliest stages, you can't get debt. And so SVB, the portion that they will have a hole is they did provide venture debt because it is a very different underwriting process when companies do. It's not a huge part of the industry, and Stifel hired a SVB team already. I mean, it will just be an opportunity that's filled quickly within the ecosystem by other banks. But I just wanted to mention that because venture does not really use leverage.
Right. So no debt, but the venture firms have typically cash that they've raised or whatever. Steve, your firms are typically line of credits with banks, I assume, drawing as they need, but making sure they have enough. Any perspective on liquidity?
We work with hundreds and hundreds of general partners, and I think Kelly said it. It's really about looking for best practices and governance, and oftentimes I think you'll hear a lot more about redundancies, and so I think there's a chance to learn from that. But I do think the industry at large had exposure to SVB, but you think about how large the industry is. There are a lot of SIBs that the systematically important banks that I think will become that will become an acronym that we'll use more and more. But they are important too, and so there's no one bank for the industry. But I do think that the lessons will be taken across the industry as we move forward. And I would say it's also a bit of a lesson in diversification, right? So you think about where they perhaps could have better diversified the tenure of their bond purchases. That alone may not have been enough, but
even
it
their
certainly...
customer base.
And their customer base.
Concentrated in venture.
That's an excellent point, right? So you think about different things as we all look at our own businesses, we all look at our own portfolios. There's it's a matrix of things that are important.
Yeah. You mentioned governance. Maybe just another distinguishing factor between a buyout and venture capital is the type of governance that you have on the company. Steve, you want to comment on the governance model that you have with some of your companies? I mean, you own those companies.
Yeah. And I think you'd asked earlier about the perceived, when we were talking earlier about the perceived risks in private markets. And this gets to your governance question because I think that there has long been a perception that privates are riskier than publics. And I think on the one hand, there are risks to the investor. Yesterday we talked about the liquidity and risk. You're making a 10-year limited partnership commitment, so there's a risk there. What wasn't mentioned yesterday on that vein is this probably applies more to personal investors into private equity, but you make a commitment to a private equity firm, and that's going to be called over 3 to 5 years, and you've got to have that liquidity available to fund those capital calls. So there's an opportunity cost a bit, to have that money available. So, but back to the risks and the governance question. In privates, it's long been held that I think there were greater financial risks and greater business risks. And I would say the financial, in part, is true because of the leverage usage that we've talked about, and I think that there's a degree of truth there. The business risk piece, I think, is something that is a misnomer. People have always thought because so much of private equity happens, and particularly in the buyout world, happens in the middle market, that these businesses aren't big enough to manage in the downside, to sell off pieces of the business, to rationalize costs. They're not big enough to attract a A-plus management team. Maybe they have concentrations in customers or vendors or other business risks. And I would say that is unequivocally not the case. I think that Jackie's colleague yesterday said there were 150,000 roughly businesses over 100 million, private businesses over 100 million, and then you have multiples of that if you're looking at businesses under 100 million, even that 50 to 100 range. There are phenomenal businesses in there, just the attributes of their business. And then when you layer in the governance, this is coming full circle to your question.
It's a great circle.
I think one of the beauties of private equity is you have active ownership and you have nimble governance. I mean, we work with our businesses, certainly weekly and many times a week. And we have standing calls with our CEO every week. We have, of course, under the manage what you measure heading, we have a very, very active, KPI reporting, mechanism.
What is KPI? I had that question yesterday.
Key performance indicators. So things that we are, we get financial statements, of course, those tend to be, rear view. The KPIs are supposed to be forward-looking and help them drive the business. So on the governance front, you have this real active ownership. Then you have, this is again muting the business risk kind of, I think, myth. You have wonderful alignment between your managers and your investors. Because our managers, and this is very true across the whole sector, they are big owners of the business. And we're the controlling owner, but they're big owners. So we are absolutely in alignment, and as we're trying to build this company and create value. And then the other thing is, and this has changed over my 30 years in the industry, is the quality of the managers that want to be in the privates has changed dramatically. I mean, I'm on a public board, and I know the challenges of operating in a public environment. These leaders like the lack of media attention, the lack of focus on quarterly earnings. They have a big economic opportunity in a private company. And so, the people we're attracting, even in our middle market businesses at the C-suite, absolutely incredible. So I just think the business risk, assumption, I would put it as in the mythological category. I'd acknowledge some of the financial risk.
Right, so you're a strong advocate, private equity, not as risky as what people think it really is.
Yep.
And if you remember, Dave, just worth recalling the graph that Drew showed yesterday, which is the data shows us that is true, right? So a public company, he used the term catastrophic loss, which means 70% of the value is gone. That happens, I think the number was 40% of the time in a public company, one company, right? 20% in a private company. And then you think about what Kelly was talking about, in a fund structure, 3% of the time. And so we often say exactly what Steve said. Privates outperform because of that governance, because of that alignment, and because of that time period. And the data supports it. So I think that's a big piece of what's challenging for investors in the private markets is that data, while there, is not easy to access. To be able to analyze, just like you do on the public side, what is the risk of loss? What has happened over the last 10 or 20 or 30 years?
And to the data point, it is becoming more available. Here in
Yeah.
Chicago, Steve Kaplan, University of Chicago, has done some amazing research. He happens to be an investor in our fund, so I've got to give him a plug. But it's really clear the impact that private equity, the active ownership, has in driving operational improvements.
Right.
I mean, it's there in the data.
Right.
I would say that in venture capital specifically, if you look back at the last 25 years, the return for the top quartile managers is 25%, where the markets are 10%. So, the risk is not choosing the best managers, but talking about active managers. That's our job, right? We're very good at finding the managers. In venture, it tends to be former operators. They've actually built businesses and understand the process and can identify what can work and can't.
So what are those characteristics of great venture leaders, managers? And they're probably very similar to what Steve's seeing in terms of buyout, but when you look for talent to run a company and build it so it's the next high value exit.
Well, our managers at the company level are looking for founder market fit, typically somebody who has big ideas, who has the grit, determination, and drive, who's going to walk through walls for that company, right? And there's a founder market fit. Either they have experience there, but we think of the same thing as a GP market fit. What is the person's experience that leads them to be able...
The GP is the head of the fund.
The GP is the head of the venture fund. And so what is their experience that gives them the credibility for a founder to give them percentage ownership of the company for money in exchange, right? But it's still, it's a competitive market. So why are they going to choose that person to lead the round? And so we really dig into that person's networks, their credibility, and the market fit.
Okay. I think we'll open it up for a Q&A here in a second. I have one question to lead into. A lot of the people in the audience are maybe already limited partners or part of funds. From your perspective, what makes a good LP? So in contrast to we're always looking at investors looking at funds saying, oh, I want to find the best funds, but some of the funds can be choosy about the LPs that they bring in to their funds. How do you think about that? And how would you describe good LPs?
Well, for us, and of course we're flattered, then whenever...
I mean, you were telling me last night you could have raised many hundreds of millions more. You didn't. So you could choose who your LPs are.
Well, I'm flattered anytime anyone wants to invest in any of our funds. I'll just start with that. But we are, because we only buy businesses from entrepreneurs, if that's your strategy, you can't get too big, because that just forces you out of the market where the N of opportunities is the biggest. And so we've made our share of mistakes, but the thing we've done very well is we've been super disciplined on fund size. And so our fund sizes are, modestly bigger every time. Fund 7 is only $450 million. But that gives us the capacity to serve the market we want. But yeah, so we have real loyal investors at this point. Our returns have been very good.
And I would assume on the venture side, same thing. You've had a consistent strategy.
Yeah, I mean, Michael, when he founded this, was very early to seeing it. In venture, we all want the $1 billion exit, right? $10 billion exit. That's what you're hoping for. But at the end of the day, there's a real probability that it's not going to be that high. So we really focus on portfolio construction and what the ownership of a company is, and is it realistic to return the fund. And so we're very disciplined. Again, it's back to the high conviction investing, large ownership, small funds, disciplined about fund size, because that does matter. If you're just growing AUM in venture, you're just deploying capital.
But back to your question on LP, just to finish that thought. So I think that it's real important, if you're going to be invested in private markets, to understand the strategy.
Right.
Because again, there are so many different strategies. Like ours, for example, almost always we will buy a company and SG&A will grow. So EBITDA will actually contract when we buy the company. And so if you're an investor and you don't have an understanding of our strategy, that's going to set you back. So a clear understanding of strategy, and then having the conviction that you're going to stay, or from my perspective as a GP, understanding that if we perform, they're going to be with us for the long haul.
Great. Questions? Got a couple here?
Sure. So maybe you could give some advice in what issues we should take into consideration for a committee that's beginning to look at private markets? I'm going to stick with private equity just to make it a little bit more specific, because we know that when we're making that first commitment to a fund, we're really starting a private equity program.
Right.
You know, because you do need that diversification over years, and then eventually you want diversification of strategy. Then you might even get into more private markets and diversify in terms of private credit, private real estate, or those kinds of things. So you're on a committee, they're considering starting a private equity. What kind of advice would you give them, and what issues should they consider?
I'm happy to start. What I would say is a couple of things. First, what you've described, which is education. You know, educate, have the committee spend some time understanding the private markets. A lot of what we've talked about, the different opportunities and strategies and what they can bring. Then really look inward and understand who you are as an organization, what's important to you, what types of risks you can or cannot take. Liquidity has been mentioned a lot. That's really important in private markets, to understand the cash flow profiles, the cadence of cash and investing. And then work with people who can share the data and can help you get access. I think one of the things that's so difficult oftentimes for committees is they think that what they can invest in is the only thing that they've been introduced to. Someone works with someone who knows someone who has invested. That's usually not the best strategy. So have a strategy. And then, as Steve said, commit to it and build over time. Think about diversification. Think about, you know, anchoring to a core holding, perhaps. It's a fund of funds, or it's a diversified play, or it's a couple of funds, and then build over time. And so I think it's all of those things, and ask the questions and continue to learn, and then continue to reflect. Are we meeting our objectives? Is this the right strategy? And that will give you the opportunity to continue to expand from there.
Since you're firing one bullet initially, one fund. There is, in private equity, the research would support this idea of persistence. So if funds have been successful, historically, they are much more likely to be successful in the future than in the public markets, for example. So find a fund that's been successful and then drill deeply into what is their strategy and who are the people. So you want consistency of strategy and consistency of people. And if they've been successful, that's a really good place to start, in my view.
And CIS Venture Access Fund has that.
It certainly does.
You know, this is a fascinating discussion, and I love the idea of going out and buying companies. One thing that hasn't been mentioned that I'd be curious about is, what is the process or criteria you use at the point in time when you decide to sell some of these companies that you've invested in?
Want me to take that? So it's a multi-layered analysis, because when we buy a company, we have an investment thesis, and it's going to take typically at least several years to execute on that thesis. We want to have enough time to have the fruits of all those investments we're making bear out. So that's one kind of screen. Secondly is we have to be attuned to the kind of M&A market broadly, and specifically what's happening in that subsector. And then thirdly, other factors, what's happening in the economy, what's happening in the debt markets, and if you can, and then I guess the last thing I would say, which is a real important consideration for us, is our management team partners, what do they want to do? If they've gotten to the point where they feel like they've created a ton of value and this is a chance for them to have a great liquidity event, and we have a lot of respect for that particular point of view. So this is a combination of those four things that lead us to decide now's the time.
It's an important question, though, and Steve, Kelly, you can probably comment on this as well. Is an important part of understanding, as Steve was saying, look at what groups have done in the past. Do they exit? How do they exit? Do they hold on to companies for too long, or have they marked them up but not actually seen some exits? And so the evidence of the ability to stick to, as Steve said, a plan and a strategy for building a company and then exiting and distributing those proceeds back to investors.
Great. Question in the back. I think we have time for one more. Tom? Okay.
Thank you so much. I don't want to get too esoteric, but I did want to ask the panelists what perspective, if any, or what question is the moral dimension of the Catholic understanding of the human person? And maybe an unfair question, I don't know if you're Catholic or not, it doesn't even matter, but the point being that, for example, Kelly, you mentioned artificial intelligence, that's here to stay. The human person, from the Catholic Church perspective, without being a theologian, is to being formed by God, for God. The perspective of the market sometimes is we are consumers, we're utilitarian. So what, if any, advice would you give some of the leaders here to introduce them to this moral, ethical thinking of the view of the human person to a bit more comprehensive than just a consumer?
I'll jump in. I mean, I think that's a good question. How do we live out executing our business strategy in the private markets against the backdrop of our values and our Catholic faith? And I think that's critical. And in my view,
it might be easier in the private markets than the public markets to do that, right? I mean,
it may be. I mean, one, it's around portfolio construction. What the kind of companies you invest in. I mean, I like the companies I work with right now. For example, one's a child enrichment business. One is a social emotional learning company. One is a business that helps recover dropouts and get them re-engaged in their education. One's a hospice. Those are the companies I spend a lot of my time. So some of it's portfolio construction. Two, it's how you do business. We take a lot of pride at Prairie on our partnership ethos, how we partner with our investors, how we partner with our management teams, how we partner with each other. And I guess at the core of that is just an idea that we want to make money with people, not off people.
And I would add to that, I mean, I think Steve gives a great example of the companies he's worked with. The broadening of the private markets opportunity set really does allow for alignment. And so I think you can think about that in a couple of different ways. Many organizations have a strong ESG policy, which identifies the opportunity to dig in to the companies that they're investing in and to either, we think of ESG as a risk framework, just understanding how companies interact with the environment and society and governance. But you can take that as a platform and go further. We're going to talk later today about impact investing. That's one way where you can take a strong framework and you can jump further into proactively identifying companies that are positively impacting environment or society. And so I think that you can have your framework and then you can look for that alignment. And so it doesn't mean every investment will be for you, but there's such a broadening set of opportunities. And it really comes from more and more investors seeking exactly that. And so, Steve gave great examples, we can give others, and I think that private markets do align well for that opportunity. I think even a little bit more so maybe than the public markets at times, where it's much more of a negative screening than potentially a leaning into that positive change or positive alignment.
Dave, let me, if I can, butt in and give a little commercial for what we do with both Hamilton Lane and Sendana, because we've spent a lot of time with Hamilton Lane up front educating them about the Catholic SRR issues. We really invested a lot of time, and they were very receptive to that education, and so now they've incorporated it. Again, we're talking about private markets broadly here, but our focus has been on impact in our first strategy, and so they're very sensitive, very aware of those issues as they approach their impact investing, and we've negotiated an opt-out, which fortunately up till now we haven't had to use, but it's been a very, very intentional process, and when we partnered with Sendana, with Kelly and Michael, they couldn't have been better about working with us on that, and then we actually did some back testing to look at the investments that they'd made, and we came away very comforted that they were very much in alignment with Catholic social teaching. So again, I'm sorry to butt in here, but I thought that was an important factor.
Yeah, and I would like to say when you talk about venture, these people could make $500,000 plus at Google. They're choosing to make very little salary to start a company or to work for an early stage company for more than money. So it typically is a mission to change the world for the better. There's something that they can see being done better that will make humanity better, make people's lives easier. So, there's a trade-off. These people are very talented and can make 5-6 times as much money working for any other company, and they're choosing to do this and to build from the ground up. With the lottery ticket that there's equity at the end, but there's a real belief in more than the money.
I think just a summary statement on private markets, though, all of us get energized about helping companies in the private market grow, succeed, create jobs, economic development, opportunity. That is an exciting part about what we do, and it can be done in a very smart, just way as well. So I want to thank the panelists. You guys were awesome.
Thank you.
And thank you for that.
Thank you.